Oil has just staged another geopolitics-driven surge, and equity leadership is being forced to rethink what comes next. Welcome to vTalkInsight, Equity Pulse Daily for July 9th, 2026. We will unpack how the latest Middle East shock, shifting rate expectations, and a bruising rotation in AI and semiconductors are reshaping the risk-reward for global equities. The dominant macro story for equities now is a sharp escalation in US and Iran tensions that has flipped markets into a more defensive stance. The US president has effectively declared the ceasefire over, Iran has launched attacks on Kuwait and Bahrain, and Washington has struck more than 80 targets in retaliation for tanker attacks. That combination has pushed geopolitical risk from background noise to a central driver of pricing in energy and broader risk assets. The Strait of Hormuz is back at the center of market focus because it concentrates up to 20 million barrels per day of oil flows, roughly one-fifth of global supply. Commentary suggests flows from the Persian Gulf have already dropped and then partially recovered to about 70% of normal, helped by rerouted pipelines and resilient production, but the reopening path remains uncertain. Investors who previously treated Iran's leverage over transit as theoretical are now being forced to price a very practical disruption risk. Oil has reacted violently, with prices jumping around 6 to 6.5% on the day of the ceasefire announcement and Brent moving towards $79 per barrel, while European gas futures climbed more than 5%. What is striking is that this spike comes against otherwise soft fundamentals, including weak Chinese imports and increased Russian exports, which would normally weigh on crude. The real pinch is in refined products like gasoline, diesel, and jet fuel, where damaged refining capacity and low inventories are keeping markets tight, even as crude supply looks manageable. Persistent oil in the $70 to $90 range is now seen as a regime that can stoke inflation without immediately killing demand. That raises the risk that central banks are forced to lean more hawkish, not because growth is overheating, but because energy keeps headline and expectations sticky. The commentary points to rising U.S. inflation expectations and higher Treasury yields across the curve, as well as increasing sensitivity at European central banks, which appear more inclined than the Federal Reserve to react if crude stays elevated. There are offsets. Both Washington and Tehran have left the door open to further talks, and regional mediators like Turkey, Saudi Arabia, and Egypt remain active, while France and other European powers are offering military support to secure Hormuz. The U.S. administration also has an incentive to avoid a prolonged energy spike heading into midterm elections, which argues for pursuing at least a temporary accommodation. Even so, several voices warn markets may still be underestimating just how fragile any ceasefire is, which leaves a clear message for equities. Watch oil and refined product markets closely, because they are now the swing factor for both inflation and earnings in energy-sensitive sectors. The move in oil is feeding directly into rates and credit, raising the discount rate that equities have to clear. U.S. Treasury yields have pushed higher across the curve, with the 2-year moving above 4.2% and inflation break-evens nudging up as markets reassess the path of prices. In Europe, 5-year and French government bond yields have jumped even more sharply, reflecting a mix of energy anxiety and rising political risk. The policy narrative is nuanced. Fed officials remain worried about sticky services inflation and survey-based expectations, and June minutes are expected to show a sizable block still open to at least one more hike if data do not cooperate. At the same time, several comments stress that a temporary oil pop at current levels is not enough on its own to trigger a change, which supports a hold stance for now and is consistent with market expectations that rates stay on pause through year-end. By contrast, European central banks are signaling greater willingness to lean hawkish if crude stays high, reinforcing policy divergence and a stronger dollar backdrop. Higher base yields are colliding with heavy corporate supply, and that is where some of the more interesting cracks are appearing. Corporate bond issuance is expected to run near $1 trillion a year for the next 3 years as refinancing ramps up, and investors are already demanding wider spreads and bigger concessions. Amazon's recent $25 billion bond, which is partly about pre-funding AI investment, drew relatively weak demand, with coverage ratios roughly half the usual investment-grade average and spreads widening by 20 to 25 basis points as books shrink. For equity markets, the implication is that the era of near-free capital for megaprojects, including hyperscaler AI infrastructure, is fading. Rising borrowing costs are already prompting some companies to lean more on equity issuance and convertibles, and to reassess the pace of capital spending. That puts a premium on projects that can deliver faster cash returns, and it increases the sensitivity of richly valued growth stories to any disappointment in either funding access or demand growth. On the surface, headline equity moves still look contained, with recent S&P 500 declines measured in fractions of a percent and volatility indices drifting from the mid-teens toward the high teens rather than spiking into crisis territory. Beneath that surface, however, the tone has shifted toward broad risk-off, with the S&P, Nasdaq, and Dow all posting sharp down days around the Iran headlines and the Dow underperforming. Global risk sentiment has deteriorated too, as sector and regional moves react more violently than the aggregate indices suggest. Asia is a clear example of that divergence. South Korea's Kospi index has now fallen about 20% from its peak, meeting the rule of thumb for a bear market, with intraday swings described as extreme and leveraged chip-focused exchange-traded products down around 50%. That deleveraging has generated systematic selling pressure and global trend following stress, particularly in tech-heavy exposures. At the same time, Hong Kong technology stocks are holding up better, and there is renewed interest in India and Singapore, highlighting an internal rotation within the region rather than a simple regional exit. In the US, the earlier rally had already started to broaden beyond AI leaders and communication services, and that trend is now intersecting with the risk-off move. Non-tech sectors such as hotels, refiners, non-traditional banks, rails, and parts of healthcare have been setting new highs, while energy stocks are now clear relative winners as oil surges and most other cyclicals trade lower. Large U.S. banks are also outperforming on the back of higher portfolio management and investment banking fees, dividend and buyback increases after stress tests, and the prospect of a steeper yield curve. Europe shows a different split. Banking names like Société Générale and Deutsche Bank are under pressure, as markets worry about bond market volatility, fiscal sustainability in countries such as France, and the knock-on effects of higher yields. By contrast, European defense stocks are supported by a sharp step-up in spending, including a roughly $50 billion NATO initiative for long-range weapons and more coordinated procurement across the UK, France, and Germany. With the U.S. also licensing local Patriot missile production in Ukraine and NATO allies considering greater role in securing Hormuz, defense and related industrial names continue to emerge as structural beneficiaries of this security environment. The most dramatic rotation inside equities is happening in AI-exposed technology, especially semiconductors. After a record second quarter driven by memory chip demand for AI workloads and broad earnings beats, the Philadelphia Semiconductor Index has dropped about 15 to 16% from its June highs. U.S. names like Micron and SanDisk have seen declines of more than 6%, and many chipmakers now trade near one-month lows despite still robust profit growth. Importantly, the commentary does not point to collapsing end demand for AI compute. For leaders such as NVIDIA and Micron, there is little evidence of order weakness, and valuations are described as closer to, or even below, broad market multiples rather than at bubble extremes. Instead, the concern is about the sustainability of hyperscaler capital spending in a world where borrowing costs are rising, AI infrastructure is more expensive to build because of labor and construction inflation, and bond investors are showing greater caution toward large tech issuance. This shift in focus from pure demand to funding and risk is visible in individual headlines. NVIDIA shares dropped nearly 5% in pre-market trade after Wolfspeed filed a patent infringement lawsuit, injecting legal uncertainty into what had been treated as a near-perfect growth story. Amazon's AI-linked $25 billion bond, while ultimately successful, saw more modest investor appetite than typical high-grade deals, highlighting that even the largest platforms are no longer guaranteed cheap capital at scale. At the same time, the AI ecosystem itself is broadening beyond a handful of GPU suppliers. Apple has committed around $30 billion to Broadcom for US-made chips, alongside a $1.5 billion investment to expand manufacturing capacity in Colorado, and Broadcom is projected to capture roughly 60% of the custom AI server chip market by next year, which has helped propel its shares higher. Meta's planned $10 billion data center in Canada, large-scale data center construction in the U.S. Midwest, and Microsoft's shift toward its own models inside Office all underline how CapEx is migrating into more distributed, vertically integrated architectures. These dynamics are also driving rotation within global tech benchmarks. Recent results from Samsung suggest AI demand has largely caught up with lofty expectations, reducing the scope for upside surprises in Korean hardware and contributing to the bear market in the Kospi, even as SK Hynix is described as undervalued on forward multiples. Capital is rotating toward areas like Chinese internet, where Alibaba is rallying strongly on renewed optimism about its core e-commerce franchise ahead of an earnings preview, and toward infrastructure software providers such as Datadog and Cloudflare, which stand to benefit as organizations grapple with the complexity of operating large, distributed AI systems. Outside tech and energy, the oil shock is creating clear winners and losers at the stock level. Airlines and cruise lines are under pressure as fuel costs jump, with the U.S. airline index down close to 2% and American Airlines off around 4%, reversing some of this year's strong gains just as earnings season approaches. UK homebuilder Vistry is another casualty, warning of a £30 million pre-tax loss and seeing its shares drop about 8% as higher raw material costs and weak demand linked to mortgage affordability bite. Yet the broader consumer picture remains more resilient than those headlines suggest. Spending on events and travel is described as holding up well, supporting the idea that the U.S. economy is experiencing a slowdown without outright recession. Within that, there is meaningful dispersion. SiriusXM has rebounded roughly 40% year-to-date on improved cash flow and record low churn. Levi Strauss managed to beat sales expectations and raise guidance, but still saw its stock fall around 5% on lingering skepticism. And Bath & Body Works faces downgrades as analysts flag weaker brand momentum and risks from expanding distribution through Amazon and Ulta at the expense of its own stores. Finally, there are signs that some capital is rotating toward perceived stability and long-duration growth. Global sovereign wealth funds raised about $200 billion for U.S. infrastructure in 2025, pointing to demand for assets with more predictable cash flows as stock and bond correlations become less reliable. At the same time, private market and venture activity remains alive at the higher risk end, with Blue Origin preparing a $10 billion external funding round at a valuation near $130 billion, underscoring that investor appetite for transformative growth stories has not evaporated, even in a more volatile environment. Stepping back, the equity picture now sits at the intersection of a geopolitical energy shock, a gentle but persistent rise in global yields, and a powerful rotation within and across sectors. Oil and refined product markets are the immediate swing factor for inflation and central bank reaction, feeding into higher funding costs and more discerning credit markets. Within equities, leadership is shifting away from crowded AI and semiconductor trades toward energy, financials, and defense, even as the broader AI theme evolves into a more complex ecosystem spanning custom chips, data centers, and infrastructure software. At the same time, consumer spending and many corporate balance sheets still look resilient, which supports the idea of a choppy, dispersion-heavy environment rather than a uniform downturn. From here, the key signals to watch include developments in the Strait of Hormuz, the trajectory of oil and refined products, the tone of upcoming Fed communications, and how megacap tech guide on AI capex and funding. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.